about is the DREAM program. So let's get right into it. So market updates. Fed balance sheets has risen almost $400 billion in the last 2 weeks. So pretty much the banks are borrowing more money and they're borrowing it from the feds. What's going on? Well, Powell and Yellen, both Fed chair spokespeople, are saying that it's safe. They don't really need it. But what's happening? What's causing the banks to borrow all these funds? Because you have to remember, the Fed is the last resort you want to borrow from. So even though you're getting a 2% return on your money, you still need to pay back the Feds at a higher rate. And right now, the Fed fund rate is at 4.75%. It's kind of like taking a line of credit, a home equity line of credit, then putting it into a savings account at 2%. Just doesn't make sense. Unless I really need the money, doesn't make sense. Pretty much it's showing that the banking sector, that there's a liquidity issue. So what's going to happen is we're going to see a pullback on certain programs. So you're going to see lower loan to LTV limits. You're going to see tighter debt to income ratios. You're going to see higher reserve requirements across the board. So for example, if I wanted to get a line of credit, I'm not going to be able to get it above the norm of 250. I'm not going to be able to get a $500,000 line of credit. I won't be able to get my debt to income ratio is going to be tighter on jumbo loans, or the jumbo lenders will ask for even more reserves. Basically, it's restricting and pulling back on lending. And it's going to help, actually. It's going to help with inflation. So there's going to be less spending overall, and it's going to lead to the rates getting better down the line. Now, when that'll be, we don't exactly know. My prediction is May 10th is going to be the catalyst to lower rates, because there's a lot of housing data that's going to come in. It's all going to come playing together, and you're going to start seeing the trend of high rates come down. Well, where are rates right now? Rates as of today on conventional financing is 7.25. I didn't list it here, but FHA is slightly lower, about 6.99, similar to jumbo. But keep in mind, FHA has higher premiums, upfront PMI, monthly PMI. So that's where it stands. Now, to get to the part where everyone's waiting for, the DREAM program. So remember, CALHFA is the agency that's providing this loan program, but they are launching it on March 27th, and they're launching this entire training program of how it works in and out, the guidelines, what the rates will be like, what program is it tied to, and how it all plays together. In the meantime, however, they've shared some information as far as how it's going to work. So what we're going to do today is just go over the general process of how it works. So let's take a look at it. So say you're buying a $500,000 home. Well, normally you would have to put, 20% down or, 3% down. You have to bring money to the table. What this program does is allows you to buy a home with essentially nothing out of pocket. Again, we're waiting for the details of what needs to be brought from the buyer, but my understanding is you don't need to bring anything to the table. So if you're buying a $500,000 house, 20% of that is $100,000, right? So that's the down payment. So you have a first mortgage of $400,000, and then essentially a silent second of $100,000. Well, let's fast forward 5 years. This home is worth $640,000. So there's an appreciated value. So if you sell it, now there's $145,000 at the stake. So what this program does is it's an appreciation share. So what they'll say is, okay, you made $140,000 in this home because you bought it at $500. Now it's been 5 years, it's worth $640. So the home's appreciated value is $140,000. Immediately, they want their original $100,000 back. So they're going to take the $100,000. Then from the appreciated value of $140, they're going to want to take 20% of that, which is $28,000. So let's look at the example then. We're going to go through each tier, and I'm going to give you some other examples. So I bought a home for $500,000. Let's go over that again. I sold it for $640,000. Well, remember, I had a first loan of $400,000. Let's put aside the second loan, the $100,000 that you got for the down payment. Let's just work with the first mortgage. Well, in 5 years, you've chipped away at it. So that's your money that's going into the home. Well, now the loan is $370,000. If you remember, they want their original $100,000 back. So this $100,000 is here. Then they also want 20% of this new appreciated value of the 140. That's 128. So when you subtract the 370 minus the 128, that means you are left with about $142,000 of equity. So that's your money. It's you wouldn't have had this before if you didn't get this program. Now, what I'm waiting for is I'm waiting for the details to come out so we can have something to compare and contrast with, because we don't know what the rates are. We don't know what the program terms are. So if we can understand the terms and itemize it, so we'll take the DFA, the Dream for All program, and put it on the right side. And we take all the benefits of it, the payments, and then the 5-year appreciated, and then the profit share of how much you end up netting. Then we take a standard loan program and we do it something like 3% down. We're able to compare it and see what makes best sense for you. This is great because you're able to get into $1 million home. I mean, in this case, it's 500, and only, bring in nothing to the table, but your payments reflect that 20% down. So let's give another example. So this is more in line with what we have in LA. You're going to buy a home. You're buying it at $1 million. You're putting nothing down. The Dream for All program is putting 20% down. So essentially, you have an $800,000 first and a $200,000 second. So you're buying this home at 100% value. You're borrowing all of it, right? 5 years later, it's worth $1.4 million. So you appreciated $400,000. So that's new money. Well, the down payment assistance program is going to want some of that money back. And here's how it breaks down. Did I lose that sheet? Hang on a second, guys. It got deleted, but we'll just do it by hand. Can you guys see this calculator in front of me here? Someone just reply back yes or no.
No.
No? Okay.
No, we can't see it.
Let's share this calculator as well. No, let's share the whole screen. Can you see the calculator now?
Yeah, we can see it.
Beautiful. Okay. So I'm buying this home for $1 million. 800 is the first loan, 200 is the second loan, but the 200 is hidden, right? Because you're not paying any money on it. There's no interest on it, that we know. There's no payments required on it. So far, the understanding is the only time you have to pay it back is when you sell the home or you refinance. So my understanding is if you keep this home for 30 years, we don't know what's happening to that $200,000 that originally came from the down payment assistance. So we're waiting for that information to come out. Next week, we'll know it. We'll go in more depth as far as what's happening. But for now, let's work with what we have. So you have an $800,000 first, you have a $200,000 second. Now it's worth $1.4 million. Well, 1.4 million minus the $100,000 or $1 million you bought it for, it's $400,000. So, well, what's going to happen to that money? What portion is mine? What portion is the lenders? And how does it work out? Well, we take 400,000. Immediately, they're going to want their 200,000 back. Okay. So I'm going to put this here, 200,000. That's their first 200,000. They want it back. Then they're going to want 20% of this 400,000. That's $80,000. So let's put that over here. So that's the original 200,000 they gave you. That's 80,000 that appreciated. That's the 20% portion. Well, what's left for you? Well, let's take a look. Let's say in 5 years, because you're chipping away at that mortgage, you're paying every month, you naturally bring down the balance. And again, we don't know the interest rate. We don't know the program terms. So we're just going to guess and say in 5 years, you chip away 50,000 out of the 800,000 first. Well, now you have to pay off that 750, right? Well, let's run through the numbers. So you have 1.4 proceeds coming in. You pay off the first loan of 750. You give the original 200,000 back to the lender. Now you give an $80,000 appreciation share. That leaves you with $370,000 in your pocket. So when you sell this home in 5 years at 1.4 million, you net $370,000. That's money you would have not had before because you didn't have a vehicle, a tool to get into this home. You would have otherwise had to put 3% down and then been exposed to a really high payment, or put 10% down or 20% down and be exposed to that high payment. So this is going to be a great tool. It's going to allow a lot of home buyers to get into a home, or a lot of borrowers to get into a home that wouldn't have been able to otherwise. Where we know what we do know is it's a limited amount of funds, so we don't know how long it's going to last. The last time this was done, it lasted about a few months, so I think we're going to have some time. Two is, well, what's the closing period? So if you go write an offer on a home that's $1 million and someone else has traditional financing, well, in my experience, when you're working with a third party, there's a new agency, the transaction's naturally going to go slower. So where we're closing transactions in 20 days, this might close in 30 days or 45 days. So that's one thing we have to look at as well. But it won't be an issue because at the end of the day, it's still money. It's your, it's your pre-approved. You get to buy a home and it's borrowed money that you can have. So what I'd really like to do is have a full understanding of this once it's released. understand what the terms are, understand the breakdowns. And I myself am going to sit around and play with some numbers and put some diagrams together in Excel sheets and break it all down and have an understanding of it, so we can have apples and apples to be able to compare it with. Because right now we have nothing to compare it with, because we don't know what the payments are. We don't know what the interest rate's going to be. We just have an idea of how it's going to work. And at the end of the day, it's an appreciation share. Now, what are the requirements to qualify for this? So it's based on income limits. The way it works is there's a census tract in America. Every zip code has an average median income. In Glendale, I think it's like 85,000. In different cities, it could vary. Now, other incentive programs, down payment assistance programs, they're based on these numbers of $80,000. So I'm going to step away from this dream program and talk about other programs and come back to this and tell you why it's special. So there's another program where it'll give you a $20,000 down payment, but it says you have to be 80% of the average median income. Okay, well, what does that mean? So the average median income is $80,000. Okay, follow me here. So we want to buy a house. My income is $80,000. I qualify for this. Well, remember, you still have to qualify for the home loan program. Well, home loans, you're qualifying on 3 metrics. You have the credit score. We know that. We have the down payment. We'll put that on pause for now. We have what's called debt to income ratio. I don't know how, there's a few people here, and of course, people are listening to the recording. Generally speaking, when you're buying a home, the bank determines your purchasing power is based on your income. So for example, if you're making $10,000 a month, the bank will say, okay, well, half of that is your budget for a home loan. So half of $10,000 a month is $5,000 a month. Now, if you have car payments or student loans or any credit card debt, you have to deduct that from your, half of that money. So for example, $10,000 a month is your income. Half of that is $5,000. $5,000 is your budget for a home loan. Well, if you have a car payment, that's now $4,500 a month for your budget. Well, remember, what kind of home does $5,000 a month get you? Not much. Probably like a $600,000 or $700,000 house, if that. I mean, that's with 20% down. If you're bringing very little to the table, that's $400,000. So the problem with all these incentivized down payment assistance programs in the past have been area specific. The income that you need to make to meet these programs are very low, and you won't qualify for any house. These are for homes that are $300,000 or $400,000. So these programs really worked in San Bernardino, Fulton, California, up north, where the homes are $300,000 or $400,000, and the average median income is 60 or 70. Here in LA, where the average median income in Glendale, for example, is $80,000, the home's $1 million. You're not going to qualify for the home. That's why they didn't work in the past. Now this program has its own set of income requirements. It has 2 categories. The income limit is $180,000, which gives us a lot to work with. $180,000 income limit will probably get you up to a purchase price, assuming you have very little debt, of about $1.3 million. So that's what we'll be able to qualify for. Whereas before, these programs wouldn't work. So that's what's huge about this. That's why everyone's talking about it. That's why it's come to light, and you're seeing it on social media, because the income limit's so high. Now, there's 2 versions of it. One is at $180,000, and one is based on lower income. So if you make 80% of that $180,000, you qualify for what's called 15% equity share. So if you remember, we went back and did this formula where you paid back the original $200,000 and then 20% of that appreciated value. Well, now, if your income is less than that 180 at a certain limit of 80% of that 180,000, again, I'm throwing a lot of numbers out there, but bear with me because we don't have all the information yet. We're working with what we have. So what's 15% of 400,000? So $400,000 times 15% is 60,000. So if you make the 180,000 or less, you qualify for the full program of you have to pay back 80,000. But if you're in that lower income category, you pay back 60,000. It's very minimal, but still, it's important to understand. So that kind of wraps up what we know so far with the DREAM program. This is all they've shared with us. We know that it's going to start on March 27th, which is next Monday. Then they're going to release a training for everyone involved, everyone that's been approved with them, which is ourselves, for example, by the end of the week. So really, next week is just going to be like kind of us diving into the waters and figuring it out. But what we're doing is we're basing the information on what's happened in the past. So that's all that's available across the board with every lender. So that's what we know so far. So I wanted to pause and open it up to everyone here to see what kind of questions we have. And if you can't unmute yourself, you can ask the questions in the chat as well. Any questions? Going once,
When did you say you'll have more information?
So March 27th, that's this Monday, the program's being released. The
Gotcha.
training, according to the emails from the CALHFA, the trainings will come in next week. So that's all they told us. We'll give you guys a formal training next week. There's no exact date, but Monday the program launches, and slowly they'll trickle information. I'm thinking by my guess, by Friday, I should be a guru at this. And for next Friday, we'll perhaps do another presentation. I might do a recording instead of doing it on this program and just send it out to everyone that's signed up with their email addresses. And I know Lila, of course. Is refinancing not an option with this program, like when rates are lower? Okay, yes. So that's another question. So remember, you have to pay back this appreciated value and that profit share once you sell the home. If you refinance, our understanding is so far is same thing. You have to pay that back at that appraised value. So let's just say you refinance. It's September. The rates are a lot lower, and you refinance, and the new appraisal comes in. Well, there's an appreciated value. Well, we have to learn, again, we don't know this yet, what's going to happen to that appreciated value. So yes, you can refinance. It's unknown for now what's going to happen to that profit share when you refinance. We'll know soon once we get more information on it, Gary. 180 is the gross income, correct? So for example, if you're W-2'd, you work at Disney, you work at Sony Pictures, $180,000 is the gross income. Now, if you're self-employed, we're looking at net income. So let's say you own a tile business or a tire shop, and you make millions of dollars a year on your S corp, but then you have marketing expenses. We're looking at, on an S corp, line 31 net income. That's the income we're looking at. Now, of course, there's more to it. We have a formula, but generally it's net income on self-employed. Salaried is gross income. That was for Tigran's question. Lily, did you have any questions, or did you wanted to go over anything else?
Not really, because I did have like a few questions, but then I figured you probably don't have that information yet.
Well, shoot it over. It's maybe someone else will hear it and it'll resonate.
I mean, there was one thing that I heard, it's interest free. But you said there might be interest on it. I'm confused about that part.
Yeah, great question. So the down payment money is interest free. That's what we know so far. Yes, you don't have to pay a penny in interest for that down payment. So if you're buying $1 million home, you have an $800,000 first, and then the down payment money, the $200,000. You're not paying interest on this. The only payment you're making is the appreciated at that point when you sell the home, and that appreciated value. You're doing that equity share. So no, you're not paying interest on the second $200,000. However, what you are paying interest on is your first loan. Well, this first loan is attached to either an FHA loan or conventional financing. We don't know what program it's going to be. So if it's like anything like normal, it's probably going to be an FHA loan. The rates are 6.875. We'll know more next week, but it's going to be somewhere around 6.875, or if it's conventional, somewhere in the 7%. So that's what I meant by interest paid. So you're not paying interest on that second loan, that silent second, that down payment money. You're only paying interest on that first loan, the 800,000 or whatever you're borrowing.
Oh, got it. Okay, that makes so much sense. Thank you.
Yeah, of course. So going once, going twice.
I have one more question. Sorry.
Go for it.
So I heard, and you also kind of mentioned it too, is there's going to be a limited amount that they give out. After that limited amount, it's going to be done. The program is going to be over, right?
Right.
If I'm not mistaken. And I could have sworn I heard someone say the number, but then I don't think they would even know until it's out. But I know that it was very, very limited. I could have sworn I thought someone said June. But again, I could be wrong. Do you know anything?
No, I don't know about the dollar amount. So it's speculation as of right now.
Yeah, right. Okay, cool. So basically whoever's gonna try to qualify for the program, they need to, it's just a limited time basically, right?
Yeah, exactly. So my plan of action for everyone that's interested in this program is be ready to get pre-approved. So once this program is live and we have an understanding of how it works, we run the numbers, we qualify you, we set you up with the options, option A, B, C, where A is this down payment assistance program, B is your, personalized program with this, without this down payment? Like, what would it be normally for you? What if you borrow against your 401k for some down payment money? So we want to explore holistically all the different options for you, because again, you're buying a house. It's not like you're buying a car. So it's important to look at all the options, know what's best for you. And if this one makes sense, then we'll go with this one. We'll start shopping for homes. So next week's going to be, next week's going to be pretty big. By Friday, I'm hoping, don't quote me on this, by Friday, I'm hoping I have the ins and outs of this program lined up, so we can start just shopping for homes with this program.
Okay, thank you so much. Armand John, sorry, one other question. Sako's next to me and he's asking, what is the minimum? And I think there's no minimum, right? Isn't it up to, he's asking what's the minimum net?
Minimum
to qualify. Net
minimum
income to qualify.
So generally the minimum that you could qualify for is $100,000 loan. So if you're buying, $150,000 house, whatever the equation breaks down to is the first mortgage. So for example, this $1 million home, the first is 800,000. The minimum loan program for the first is going to be 100,000. So we're going to probably end up at a minimum purchase power of about, I have to do the math, probably like anywhere between 120 to 150. So it's less than any home in LA. So 150,000 of a home, roughly in that range. Rima asked, will it be a follow-up Zoom after the new info? Once I have all the info, depending on the demand, I may either just email everyone on the list. So everyone's contact info that I have now, I'm going to save it, of course, and do a recording, specialized recording, going over the program and send it to everyone, and breaking it down to, how it all works. Or if there's a lot of demand and everyone wants to ask questions, we'll do a separate Zoom, Rima John, and we'll make sure that everyone has a chance to ask questions as well. But again, we're doing one-on-one. So again, I'm available all week and all the time. I live by my phone. So we'll do one-on-one presentations as well.
And also, we can reach out to you to get the pre-approval process started until this program is out. So that way, like, whoever's interested could be ready to go.
Exactly.
Right?
So okay. I could send the link to everyone here to start today. That way you're getting in your financials, you're doing your application. So once this program is live, we could just plug it in with the information that we have.
Awesome. Thank you so much, Armand John. Appreciate it.
You're welcome. I think that does wrap it up. So we're going to go ahead and stop the share and end the call. If you guys want to hear this again, I'll put it up on YouTube. I'll share the link. It'll be available by tomorrow. Otherwise, feel free to give me a call. Did I hear someone's voice?
Oh, I just said thank you.
Oh, yeah, you're welcome, Hugo. I'll talk to you guys all in the near future. Thanks again for sharing.